is rate the most important thing? No, because if you were with a financial institution, a bank, had a lower rate, your penalty could be way higher than what it would be if you go with like a monoline lender.
So what you're saying is that, if I decide to go with a traditional lender at a bank, I don't have the flexibility to break if my situation changes. I want to get out of this apartment or this condo sooner than the 5-year term. I might pay more in penalties to do that. Whereas if I take a monoline lender at a little bit of a higher rate, potentially, I may have that flexibility to potentially save more money in a penalty than I would have paid at a bigger bank.
Welcome to the Ottawa Property Podcast with your hosts, Tony McNeil and Adolfo Alvarenga. Each week, they'll take a look at what's happening in the Ottawa real estate market and offer practical advice and insights for listeners. From market updates to success stories, they cover it all. Whether you're a first-time homebuyer, a seasoned investor, or just curious about the property landscape in Canada's capital, they've got you covered. Sit back, get comfortable, and let's get into it.
You're like rushing.
No, I'm just like
excited. I know, but you're rushing. Okay, let's start that again.
Okay. Welcome back, everybody, to the Ottawa Property Podcast. My name is Tony McNeil. I am a local realtor based in Ottawa, Canada. As always, joined by my co-host Adolfo Alvarenga, a level 2 mortgage agent based here in Ottawa with referral mortgages. Week to week, we talk about what we're seeing in the news, what we're kind of coming across in our day-to-day, and how the market is kind of shaping on a week-to-week basis here in Ottawa. So if you're following along on any of the platforms, the audio platforms, give us a like, give us a follow, comment, let us know what you'd like to see or hear in future episodes. We appreciate the support. Helps us reach more people just like you who want to hear two idiots ramble on for 45 minutes. So without further ado, what's up, Adolfo?
How's it going? Welcome. How's your week?
Good. I was sick all week, but I'm feeling 1,000% now.
Okay. How you feeling? Way better?
Yeah.
So it's in time for Thanksgiving weekend. Well, it's in time for turkey.
Yeah, it's true. I was like texting the group chat with the team, and I'm like, "Oh, I'm sick again. Like, why does this always happen?" And they're just like, "You have a toddler."
Yeah, well,
like,
that's the thing.
Yeah, it's
that's
fall.
Jan usually the case. Yeah, too, like that.
I'm just like, I am the worst for it. Like, if I get sick, it's like I got hit by a bus. And Louisa hates it. It's like the man cold or flu is like very, very real and prevalent in our household. And I'm not ashamed of it. I just like, it's just, I can't function when I'm sick. I just can't do it.
Like, I have to take care of 2 babies at this point.
Well, the thing is, I've gotten better at like just isolating myself and like taking care of myself and not being too dependent on her, because obviously she does have the dogs and Sophie.
Yeah.
So I'm just like close the door and be like, hey, can you heat me up some broth from time to time? That's pretty much it. So we've gotten to that understanding, which was not so bad. But from a work standpoint, I can barely like stare at my email long enough to reply to somebody.
Yeah,
it's so tough to focus. And this one especially, I was just tired.
Yeah, that's the thing. It's like the toddlers just like, because of daycare, because of everything, they just share germs.
It's gross, man.
And then they come home and it's like, okay, well, now you get sick.
Yeah,
I see it a lot with like Jen and Leo too. Like sometimes in their household,
passing it around.
Yeah, and it's like when they're sick, I'm like, oh, everybody okay? Okay, no, I'll come back.
Yeah, I'll see you next week.
I'll see you come back.
A client of mine texted him and he was like, hey, I'm not feeling well, but I'll get this over to you soon. And he said, we got in a conversation. He's like, yeah, daycares are like a petri dish of germ breeding. And I'm like, yeah, it's fair.
That is fair.
It's gross. So. But anyway, I know the week has been good. Otherwise, it's been pretty chill. It's eerily quiet. I don't know. I feel like people are waiting for October 23rd for whatever reason. And I got a lot of questions for you, but I do. We'll get into that. But how's your week been?
It's been good. It's been eventful in the sense of like I'm dealing with a file. It's quite interesting. Interesting in the sense of for what's happening. We can get into that later. I don't know if I can disclose much information just yet, but we can definitely talk about it later. But let's give our listeners something to why they came here. Why are we have listeners here?
I don't know.
Or why are we doing this? Let me rephrase that question. Why are we doing this?
Yeah, no,
we've done this for a while. We just never published anything, so we're hoping this is the first one.
Working on it. We're so close. Yeah. Okay. Let's jump right into it then. Big news in the mortgage world. You want to go in? You want to start? You want to get us started?
What's big news? Oh yeah. The government is throwing Hail Marys right before they leave, but essentially,
I want to call it leaving.
Well,
Anyway,
we'll see.
so
We'll see what happens.
we'll see.
Maybe not. We won't get political. But
Leave would be
essentially, the
the like,
government announced that they're going to change things for insured mortgages or first-time home buyers. One of the major changes is that they are going to extend the amortization period from 25 years to 30 years. So why do you say that's important, or why do people think that that's important? Is because it'll make your monthly payments lower. So then it also make the qualifications for a specific household lower. So it ranges typically anywhere between, maybe depending on the price point, 50K difference, you know? So for some, and you might be the expert on this side, is that could make the difference from a row house, from a stack condo to a row house.
Yeah, condo to freehold,
you know?
like that. Sure, that gap could get you, into a different product type for sure.
And right now that the rates are slightly higher than what they were used to in the pandemic levels and stuff, like it monthly payment is very important.
Super important.
Especially because class liquidity, inflation, everything else is so much more expensive, which luckily things have been coming down, but until when, like, so that was one of the major announcements. The other announcement was that they're changing insured amount for a purchase from 1 million limit to I believe it's a 1.5 million.
1.5.
Yeah.
Yeah.
So that's going to change the game, especially because like when these rules were set, we barely crossed that 1 million price point.
Yeah.
Whereas now it feels like it's more of a common trend. It's not just in markets where Toronto, Vancouver, but also markets specifically here in Ottawa, you see some households. Obviously, it's not the average price point for Ottawa.
But in the bigger markets like Vancouver and Toronto, and just so everybody's aware, and those who don't know, maybe you don't know, what Adolfo's talking about in that insured million to 1.5 is that, typically anything over $1 million, not typically, but anything over $1 million would require 20% or more down payment.
Correct.
Now they're pushing that to 1.5, and like I said, it does apply to more like the Toronto, Vancouvers of the world. Like we do have $1 million price points here in Ottawa, obviously, but it's a little bit of a different market
for sure. And it's funny that you say that because like when we mean minimal down payment, when it's not 20%, it's minimal down payment. So minimal down payment, depending on the amount, is different. So everybody, or I'm not gonna say everybody, but the majority assume that it's 5% for any price point.
Yeah,
but it's not the case. And we've had this discussion before where it's like it's 5% for the first 500K, which is 25K, and then it's 10% for anything over that. So going forward, it's going to be 10% from anything from 501, call it, to 1.5.
Okay, interesting. That's how they're going to do that.
Yeah.
Okay.
So they're going to do that, and anything over, I think when you're using the 30-year AM, they're going to add like a certain premium to the premium. Okay. So like, instead of being 4%, it's going to be 4.2%.
Oh, they're making more money. Well, I want to say this too. Like, I've seen
a little bit more of a risk, right?
I've seen a lot of hate on the internet about the 30-year amortizations for first-time home buyers. They introduced this earlier in the summer for new home construction.
Yeah,
and that is implemented now. Like that is.
But they did that first for the new builds of it, and I think they, in my opinion, mentioned that they did that so that they would incentivize new construction and builders for first-time home buyers to go and buy.
For sure, the starts are dead,
then,
right? No one's
exactly.
buying those. The condo market in Toronto it's a graveyard right now. But my point is that, like, the stuff I was seeing online and the conversations I was having with people were that, like, oh, a 30-year AM, who would want to amortize that long? You're going to pay X amount of dollars more in interest, and I get that perspective of it.
For sure.
If you,
it's an extra 5 years.
Yeah, if you amortize, anyone listening, you amortize from 25 to 30 years, you're going to pay a higher interest rate for those 5 years. Like, you're going to pay more money interest. It just is what it is. But I think people forget, and this is like, I understand money's tight right now. It won't always be the case in terms of a 25-year or 30-year mortgage for most people. If you're putting lump sum payments down, you can eliminate those 5 years of amortization pretty darn quickly, and get things back in line. Or you can refinance at a different amortization at a certain point. Like, you know what I mean? There's ways around it, but if it gets people into the market now based on an affordability from a month-to-month basis, like what it's costing you monthly to carry that property, you'd rather be in than out, right?
And 100%. And you're better off getting into the market in a price point that's lower because it means less down payment. Your monthly payments would be less than if you weren't to do that and then wait until you actually can afford it. You don't know if that price point is going to stay the same. Obviously, we don't know what's going to happen down the line. We don't have a crystal ball. It's hard to kind of tell. But like you said, like, and for those listening, is if you make lump sum payments, so every financial institution, or I'm going to say 99% of financial institutions, because we don't know, most of them is the prepayment allowance, sorry, without incurring a penalty, is 15 to 20% once a year. They have other add-ons that you can add to that, but usually that's the most
as a
important one.
blanket statement.
So of the original amount, right? So that's 15%. If your mortgage was 500K, it's 15% of that 500K every year.
Yep.
It's not what you owe, it's every year. So I feel that that's also somewhat of a misconception. But
that doesn't change.
It doesn't change.
15% stays the same, and that's
exactly
the lump sum payment every year.
And it's the fifth, and it stays the same as long as you were the same lender. Okay. Or in financial institution. So even if you renew a term and it's still the same, it's still the same. If you change lenders, that's when things change differently.
Right.
However, like you said, money is tight right now on a monthly basis. So it would be important to have that safeguard in sense of have more cash. So I always see it as like, and we had a client where we did this with, and it's like, I always see it as like, try to make your monthly payments the lowest it can be right now.
Yeah.
Because the reality is we don't know what's going to happen in the next 25 to 30 years. So if your monthly payments in a position right now that's tight, you can make them lower. Then afterwards, and upon renewal, you can make a lump sum payment too, if you want, and just lower the mortgage amount that you have to renew. Like, that's no penalties at that point, right? Like, at renewal, once your contract, when I mean renewal is like if you go for a 5-year, at the end of the 5-year, that's your renewal time, you can make a lump sum payment there of whatever amount. So if you go play blackjack or win at the casino on black or red, you can make a lump sum payment directly to it and lower it. No, I don't
know. It sounds pretty professional.
It's up to you if you want, like, at the end of it, but I wouldn't do it. But yeah, so that's key.
Sorry.
Love blackjack.
I love it.
My game is War for some reason.
War.
Yeah.
Like the card game.
Yeah.
I think I know that.
It's pretty easy. It's like, but blackjack takes some skill. This one's kind of.
It's more random.
Yeah.
Okay.
Okay, you go to the casino. But anyways, we deviated. But I would say that's important. It's important to know because, yes, what you're reading online, it's what I've read online. What I read in comments, it's like, oh, you're going to be paying interest to the banks for another 5 years.
It's easy to be a keyboard warrior.
But that's the thing. It's like
easier to give hate that way.
It's easy to focus on what won't work. But how can you make it? How can we change that perspective and make it work?
Where are the silver linings in this, right? How do I take this new legislation and make it work for me?
Exactly.
Yeah.
And it's case by case. Everybody's different at the end of the day. But like, I just had a refinance, or we call them switch refinances, where like we switch from one lender to another for the client, and we extended the clients to 30 year back again, even though they were in 20.
Oh, wow.
Extended it back to 30 years, made their monthly payments lower. He just had twins.
Yeah, he needs a bit of flexibility in his monthly
because he doesn't know
expenses.
He doesn't know. Luckily, he has a good paying job. His wife has a good paying job, but his wife's going to be a mat leave. So what we discuss is like, look, let's make this monthly payment less. He has a rental property, which is great, which is renewing in 3 years, right before the term that we chose for this one.
Okay.
So then come the renewal of the rental, we're going to refinance that to take equity to then pay it off on his main residence.
Interesting.
And we can get into it or we don't. It depends on the episodes. But that's important because on rentals, you can expense interest against the rental income that you're making.
Right. Okay. So, I mean, so what you said basically in a nutshell, it's case by case. You put a plan together. It made sense, right?
Yeah.
And that one's a little bit more probably intricate than most people as a first-time home buyer would experience. But I think on the whole, it's good. It's good. I don't know. Like, I don't know what else to say. Like, a 30-year AM is not a bad thing if it gets you into the market sooner. And I think the issue is they're trying to, like, from a federal level, you have a liberal government that's saying we want to make housing affordable for the younger generations. At the same time, trying to say to someone who has owned a house for 20 years, we don't want to affect your housing prices too much. We want to keep your housing prices where they are. Keep putting equity in your pocket. So it's a very delicate balance, man, because if you're on both sides of the fence, right? So you're right now in the last couple of years, I really truly believe like first time home buyers have been just taken out of the market altogether. And I haven't preached. No, listen,
it's hard to say, but yes, I agree to an
extent. To the extent that we saw certainly in 21, 22, and even like 2018 to 2020.
But it's because the rates went up so high so quickly
Understood.
that the incomes didn't go up that quickly. So then we're still qualifying at a way higher rate than what you essentially would pay.
Yeah,
Right?
I get it, and I understand that. What I'm saying is that like now we're trying to just kind of we're putting Band-Aid on a open wound. You know what I mean? Like but it will work. It'll pump some first time home buyer back into the market.
Yeah.
Which is what we kind of need.
Yep.
You know, I'm not. It sounds a bit preachy. I'm not a realtor here saying that we want prices to keep going up and up and up. It's not what I'm saying, but just want to be able to, help people facilitate that dream. If they want to get into the market, then this is a good option for them to do it. Like, who knows? Maybe they can do it on 25 years. You don't have to do 30 years.
No. You pick it. You don't even have to do 25.
Yeah, exactly.
You could do less if you wanted to.
If you can qualify at that.
Would I recommend it? Right? No, because then it doesn't put you as the client or as the borrower in the driver's seat. It puts the bank in the driver's seat. And the last thing we want clients is for them to be house poor.
Yeah.
And cash every month have to make in terms of cash flow, right? So it's not for everybody. That's the case, but it is a tool that it's great to be there because it will help first time home buyers. Yeah. And like you said, they're kind of the beginning, the root of it all.
Yeah, man, they're the first step on the ladder, right?
Correct. And then that also affects the rental market. That also affects the buyer's market. So it's a full domino effect at the end of it. And sometimes
they know that.
Sometimes it's so tunnel vision that we use focus a lot, But yeah.
I mean, I will say like the people I have been buying with, it's generally been this year, especially first time home buyers and investors.
Yeah.
Yes, investors are buying.
There's still opportunity there.
Yeah, absolutely.
Especially right now where some houses are in the market for a good amount of time. There might be opportunity there.
Well, exactly. So anyway, that's another conversation for another day. I want to just jump into this little point that we'd made here, and I love it because it's a hot topic. I feel like this entire year, but not just as first time home buyers, but is rate the most important thing? Can I preface something here?
Go for it.
Okay.
You're asking the question.
I am asking you. So listen, this is one thing I've been watching this week. And we'll have job numbers today. They're probably already out. If we may be able to bring them up. But obviously what we're seeing in the U.S. is heavily influencing what we're doing here. Word on the street, Adolfo, is that our fixed interest rates actually went up this week.
Yeah, they did.
So is rate the most important thing?
No, it's not. And it's hard to kind of come to the client in my shoes and be like, hey, because most of the calls we get, what's your best rate?
What's your best rate?
What's your best rate? What's your best rate?
It's like nails on a chalkboard to you, isn't it? To be honest,
God, everyone's different. Like it's kind of one of those things that I've learned not necessarily make the rate the most important topic of the conversation and make it most like what's your short term, what's your long term goal.
Yeah, I know that about
on that, because at the end of the day, rate could be a bait and switch in so many cases, and that's the misconception that a lot of customers are not aware of. And I've seen it several times, many times.
Yeah.
Call it a bank product, call it a monoline lender. So monoline lenders are basically lenders that are somewhat owned by banks or credit unions and stuff, but they don't have branches. So their sole focus is mortgages. So your First National, Equitable, MCAP, RMG, like these lenders are also competing with the banks, right? What's the crazy part is that they all offer different products. They all offer different solutions. And that's when a mortgage broker or mortgage agent is so key, especially if they're good, is because the bank's limited to what they can offer.
Sure.
While we have more solutions, our office works with like over 32 lenders. We have that flexibility of
so let me ask you
not everything is straightforward, black and white. So
everything's packaged differently.
Correct.
So
everyone's situation is different.
And I understand that. You're trying to cater a package that makes sense to their situation. But if rate isn't the most important thing, like what are the other factors that you were looking at that you're going to put into this package for this client?
It depends. Is this a stepping stone? This home a stepping stone?
Let's say they're first time home buyers.
Okay. Again.
So it is. It's I want to get into the market. I'm realistic with my expectations on my price point. So I know I'll probably be in this for the next 3 to 5 years.
Okay.
like to move up into something like a townhome afterwards. I'm looking at purchasing a stat condominium probably in the $400,000 to $500,000 range.
So I'll ask the questions.
Yeah, I'm the buyer.
What's your short-term goal? What's your long-term goal for this?
So
short-term, I'll make an example. Recently got with your partner, first child. Okay, getting into the market.
Yeah.
You want something to get into the market, something small. Are you planning on having more kids?
Likely have more kids.
Questions. Okay, so then this house might be a little too small down the line.
Fully anticipating that, but it's all we can afford right now. We really just want to get in.
Okay, perfect, excellent. So let's make this 30-year AM, call it, because it's going to get to the point, hopefully by December 15th. That's when we know that's when they were aiming to make it official, and that they're starting applications from December 16th onwards. It'll be with 30-year AM. Okay, you get in, cash flow is important. You got into the house, so you need it. Okay. Second of all, what's your main goal with this house, with your debt? Do you want to be debt free very quickly? Are you conscious and comfortable with the debt of it? At any point of this, do you feel that you could be a landlord or an investor?
I feel at this point in my life, I'm not ready to be a landlord.
Okay.
I would just want to use this house to facilitate me purchasing a bigger house, like I said, in the next 3 to 5 years, whatever that looks like, if it's possible.
So gain equity from it to then eventually sell it to then buy a new one later on.
That would be the dream.
Okay, perfect. So then we have more room, more flexibility in this case, because we don't have to go to one specific institution. We have several different ones. That rate might be important, but then do you want that at renewal? Do you want to sell it, gain the most equity of it, or do things change? Do you want to have some flexibility with it? So it's important. Are you thinking of this, you're going to sell it within the term that we're choosing or beforehand? Most of it, if you choose a 5-year term, majority break that term on year 3 or 4. Okay. So then if that's the case in terms of just selling it, we would prefer to put you in a lender, an institution that the prepayment penalty is less than what it would be with your main banks. So just to explain that, the prepayment penalty is what you pay if you decide to break the mortgage fully.
Right.
So this is different to what we originally talked about at the beginning, which was like you have a 15% of the mortgage amount, right? This is you're paying out the full amount before your term is done. So term is the 1, 2, 3, 4, 5 year that you choose with the rate locked for that if you go on a fixed rate, right? So then from there, if we're that's important, because then it means that if you end up breaking this beforehand, your prepayment penalty would be less because it's not based on the posted rate of the financial institutions. What are the posted rates? Go to any bank right now, check out their mortgage rates. You will see what their posted rates are. Usually they will tell you this is the posted rate at this moment. These are our offers.
Okay.
So they base their penalties on what the posted rates are at the time that you got the mortgage compared to what their posted rate is at the time that you're breaking it, times the difference of the time that's left on your term.
Okay.
So those penalties could be hefty for some compared to monoline lenders or other institutions. They base their penalties on the actual rates that they're giving you.
Okay.
So whatever, not on special offers, but it's not based on their posted rates specifically. Their posted rates are not higher for that reason. So that's that flexibility. And that's why I say, like, is rate the most important thing? No, because if you were with a financial institution, a bank, had a lower rate, your penalty could be way higher than what it would be if you go with like a monoline lender. But it's just case by case, right? Mm-hmm. Because like then you have the other side of the coin. It's like, well, the rate was way lower, but is it lower? Because percentage wise, it could feel like a lot.
So what you're saying is that, if I decide to go with a traditional lender at a bank, I don't have the flexibility to break if my situation changes. I want to get out of this apartment or this condo sooner than the 5-year term. I might pay more in penalties to do that. Whereas if I take a monoline lender at a little bit of a higher rate, potentially, I may have that flexibility to potentially save more money in a penalty than I would have paid at a bigger bank.
Correct.
Makes sense.
So obviously you have to you have to somewhat calculate the numbers.
Yeah.
We don't know what the plans are at the end of the day, but that's usually the solution. I would talk to a client and be like, is this a stepping stone and you're looking to eventually sell this? If this is a stepping stone and you're thinking of eventually becoming an investor, that's a different ballgame. It's a different plan. You want to have some flexibility on that mortgage to take out some of that equity, do the down payment for the next one, convert that one to a rental.
Sure.
Being a landlord and investor is not for everybody.
Sure
But
isn't.
a lot of clients that I've had, first time home buyers that eventually want to get into the market, and they are able to afford carrying both properties. Like, obviously, to each their own. We're not pushing one to the other, but we've had this conversation where we feel that real estate is a good train or a good like way to create wealth, generational wealth down the line, right? And it's obviously how you prepare yourself at the time of purchase for it to be later available for you.
So I think what we're saying is that no rate is not the most important thing.
No.
The most important thing is what your plans are.
Correct.
What your goal is with this property.
Correct.
And in a short-term and a long-term perspective. But more or less, and the most importantly, in the next 5 years, what does that look like? Because we got to make this decision that's going to impact that decision in that 3 to 5 year mark, right?
And it's hard to know because at the end of the day, we don't have a crystal ball. We don't know what's going to happen in 3 to 5 years.
No.
Like plans change all the time. Like all the
betting
time.
on like an asteroid or something like that. Crazy. I don't know.
We'll drop the rates all the way down. Because that's the other conversation where you ask, like, rates went up right now.
Yes,
fixed rates went up. Why do fixed rates went up? The bonds yields reacted separately. So fixed rate and variable rates are the two different rates you could say that we kind of work here in Canada. Fixed rates are not based on the Bank of Canada announcements. That's variable rate. That's always the confusion we have every time the Bank of Canada has an announcement for the last few years. Fixed rates are based on what the bond yields to the 5-year, 3-year bonds are in Canada. These are usually heavily tied to how the market's being in terms of inflation, in terms of unemployment, in terms of price of goods. All this stuff reflects it. Call it Twitter, or well, X now. Somebody tweets something that they're going to buy Twitter, for example, in that moment. That got the market to go up. That created the bond yields to go up.
Interesting, eh?
So like it's you never know. So
a lot more variables kind of implemented to influence that rather than the variable side of things where it's just the Bank of Canada sets this overnight rate, makes X amount of announcements a year.
Correct.
And it's directly reflected by that.
Which is somewhat is affected in the same scheme of things to an extent, but it's more micro than macro type of thing, right? Economically. So the what's it called for the Bank of Canada, or why the rates went up, where fixed rates bond yields went up last week or this week, is a lot of them are saying it's because of what's happening in the US. So the US is having all these what's it called, the hurricanes, natural disasters and stuff like that are happening. The unemployment has actually decreased and there's more jobs available. So then that is also affecting the market. So that has a indirect influence on overall us, even us. Last week we had this conversation where we thought it was going to be a 0.5 of a drop.
Yeah, it doesn't look that
come October 23rd. We'd be lucky if there's a 0.25.
Yeah, it seems
there might be a hold. But this is where I always like have this conversation with clients, and it's like, well, you can't base it on what is going around. You have to base it on your specifics, because as you saw, a week things have changed. Like we, for sure, last week we were talking about this, like for sure, of 0.5 drop. You were so certain of it, and then now I was certain about 0.25.
For sure. And it's amazing how like we don't take all this into consideration. I think from a even from a consumer perspective, there's just so much like information, right? It's a lot.
And even for us that we're in the market, in the industry.
And then like you said, a hurricane happens or 2 hurricanes happen, and then everything else changes. Our rate environment in Canada, what? But so it's interesting. Like you're right. Like I sat here last week, I would have said 0.5. I'm probably 0.25 now.
I think it's going to hold.
You think it's going to hold?
Yeah.
Stay tuned for October 23rd.
We'll see next week.
Well, next week could be something different. Who knows? Like
exactly.
50 tornadoes could blow through the U.S. or something. I mean, hopefully it doesn't.
Well, hopefully not.
But it's kind of incredible the things we don't take into consideration. And like I said, there's just so much noise out there. And I think from from a listener's perspective, anyone listening, you just want to have a conversation about it, and that's all it is. Because it's like if you're trying to dissect all this, like article by article on your lunch break, it's tough. Like it's even tough for us, and we do it every day.
Honestly, I say just reach out.
Yeah,
reach out to the professionals on this, and just it doesn't have to be us. Just ask. Like,
and that's it. No bad questions, right?
Exactly.
And I'm a firm believer of that. Like, I could sit and I'll sit with Adolfo and ask him questions that I don't know because it's not my specialty.
And it's the same way. I'll ask you questions on your end because it's not my area of expertise, but we're here to help and assist that because we feel, especially this is why one of the reasons why we're doing this is because we feel that there's a lot of misinformation and misconceptions going on in the world.
There's gaps.
Exactly. Sure. That we want to kind of clear out a bit. So, yeah.
There's a lot of moving parts, guys. Just let us know in the comments or something. Like, what other questions do you have? Like, do we touching on any other, like, you have any specific interest rate questions that you'd like us to answer in the next episode? Because we'd love to hear it.
Yeah.
So without further ado, I mean, that's a lot of rate talk. Let's talk about the market.
Well, it's not the most important thing, but it's probably the major topic of conversation that we have every single week.
Well, it's it, right? Because like we get hyper focused on it. Like I said, there's a ton of noise, and we just we get focused on that. So I'm just gonna bring up some numbers here from the Ottawa Real Estate Board I thought were interesting.
Oh, we're doing market stats. Is this for September?
Yeah, they're for September. Did them a couple of days ago. Just give me 1 second. My email is a mess. Here we go. So, some stuff not so shocking. Some stuff I was actually surprised with. I think I kind of talked about it. I said inventory would spike. Mm-hmm. It's come up a bit. It didn't spike. It's about 13.3% from August.
It increased by 13%?
Yeah, 13.3%.
Why do you think that's the case?
Well, it's just like, some people when summer comes, they take their house off the market. They don't want to sell in the summertime. People check out. They go on vacation, and then when they come back, even if the kids are in school, like they get something in their head switches, and they go like, okay, it's time to sell now. Mm-hmm. So we do see that fall market kind of influx of listings to come. I think it'll likely maybe creep up a little bit into October as well, because even in the last few weeks, we've seen a decent amount of inventory come to market, which is a good thing. It's one of, I'm telling people this too, because people say like, oh, inventory is creeping up. Like, are you moving to a buyer's market? And we are in a buyer's market for certain things. Mm-hmm. The
what do you mean by certain things?
Certain home types.
Okay.
Condos, I think you can have your pick of the litter right now.
Okay.
You probably be dealing with the same thing in like a detached house above 800.
Okay.
But in like a, in the 550 to 750 range, if something shows well, like, people will fight for it.
That's the first time home buyer range.
Yeah, exactly. Well, that's it, right? And that's the reality of it. So anyway, look at this. 1,047 properties were sold in the month of September. Below the 5-year average, because some of those pandemic numbers skewed that a bit. And then actually above the 10-year average. Okay. Year over year, it's up about 11.5%. So last September, I remember it was not doom and gloom, but it was a quiet fall.
It was a doom and gloom.
Quiet fall.
It was a doom and gloom.
I'm an optimistic guy.
I'm sorry, but I gotta keep you honest.
I was
not necessarily for you, but I feel that like a lot of agents had it very hard.
That's fair.
Like in that,
it wasn't. Yeah, you're right. And I'm sure that the October, November, December numbers will be a lot of the same things. I expect that all to be in double digits.
Yeah.
Like I said, inventory is up. New listings are up almost 4% from last year. And then the sales, the new listings, as in like, what's coming to market, what's actually selling is about 45%. So, 50%, let's say, of homes that are coming to market are actually selling. The other ones are taking a little bit longer to sell. In terms of like the actual product types, this is where I found it's really interesting. So detached, the median price for detached in Ottawa right now is $760,000.
Okay.
So that's up 1.5 points from the month before, and up about 1.5 points year over year. So it's trending upwards.
Okay.
And this is like,
this is a detached home too.
Yeah, exactly. Something that has been a little bit slower, I would say, in the last 6 months. If you look back on the August, July, June numbers, these have all been trending kind of down or being pretty flatlined.
Okay.
Everything besides the condo year over year is up. And same thing for townhomes. 565 for a townhome. It's up 3% month to month.
Oh wow.
And 3% year to year. Well, 3.1 and 2.9 respectively.
In terms of the median price.
Yeah.
That's interesting.
Well, it goes back to what I'm saying. In that first time for home buyer price point, that 550 to 750, if something shows well, and that's what, a young couple making the average income in Ottawa, that's what they're looking at, right? They got a good down payment.
But the reality is that's the incomes with a combined household.
For sure. That's what,
obviously that's where it kind of sits on, right?
For those that don't know, average income in Ottawa is about $129,000. That's your household income.
Yeah.
So it's food for thought. And then the condo market, it is up half a point. It's pretty much unchanged month to month. And then year over year, it's down about 2%. So like I said, the condo market, in my opinion, is a buyer's market. If you are a single individual or even a couple trying to get into a 1 or 2 bedroom condo, like you can pretty much, have whatever terms you want, and you can probably negotiate yourself a pretty good deal. The townhome market, you got to be a little bit more, punctual, let's say, and get right to the point. It's going to be hard to persuade the seller to give you many extra contingencies. And detached, I also think of the same thing. It's kind of like the condo market. Like for a lot of the time, if someone really needs to sell, like there could be an opportunity for you.
I'm going to ask you this: do you feel that some are in the position to having to sell right now?
I think it depends, man. Like I hear so much different kind of opinions on that, and like certain people are saying to me, if you're moving, let's say, like I've helped some people move to Ottawa this last couple months. They're moving, right? They have to move. Or like let's say
they have no choice but to sell at that point.
Exactly.
Okay.
Or let's say someone bought something new construction 2 years ago and it's closing. They're moving.
Yeah.
Right? They have no choice.
Yeah.
And I've seen some of the people I've helped buy, like those timelines for the sellers have become very short because deals have fallen through on home inspections or whatever other things. So their motivation is really kicked into hyperdrive then, right? Because if they got a closing date and they don't want to bridge, or maybe they can't bridge, I don't know, their finances, but I see that as opportunity on the buying side of things to kind of get a deal done quick. It just depends on the everyone's timelines. In terms of people having to sell, I think it's just situational, man. Like people get divorced, people move, and that's pretty much what we've seen this year. Like, anyone who's kind of like, yeah, I would, I'd move if the right house came along. They're still just kind of like.
But you see how it kind of comes up to what we were talking about before, is like in a 3-year, 5-year time frame, your plans can completely
100%. Yeah, very good point.
You never know.
Yeah.
Like, so that's the reality of it. Like, how locked in do you want to be to something, right?
That's very true, right? I mean, sadly, like I've even heard situations of, divorced couples just not being able to depart from the house together yet. They're still living together because they just can't afford to sell. I think there's a lot of people in a lot of tough positions right now, but yeah. I think there's solutions. Like you said, everyone's plans change and it's worth a conversation. I think it's just the main thing. Like if you don't know, then you gotta start somewhere. But I think the numbers are optimistic. I do think like the rate environment is, like we said, is very hypersensitive to everything that's going on, not just in our country, but in North America and the world.
Yeah.
And you can't hyper focus on that. You just got to worry about what's best for you and your family, and then make the best educated decision that you can in the time of, right?
Yeah,
and not kick yourself down the line and be like, oh shoot, I should have just, if I had waited 30 days, I would have got a half percentage less on an interest rate. Like, the fact of the matter is, based on the numbers I just read out, if everything starts trending upwards, that interest rate's not going to mean anything, because even on a nominal, like let's say, we're looking at a 3 to 5% year over year next year, you will not remember the rate you got, because you're going to be saying, oh, market's up, I'm good.
Yeah, and that's the most important thing. Like the reality is, and like any online mortgage calculator can show you this. The percent, we hyper focus on the percentages. 0.25, 0.5, call it. When you put it into dollar amounts, it's very minimal amounts. Like, mind you, still amounts, but they're minimal. But like you said, what's more important at that point? That you got into the market at a low price point, or that you later have to pay more for the same household that you wanted. And that's where it's like it's do you want to stay on the fence so much that, oh, wait until rates come drop? How many people are on the fence? How many buyers are it? Like, it's not just one mortgage agent or one real estate agent that has buyers on the fence. And then it's like, okay, if the rates start coming down, prices usually start going up.
Yeah.
So then it's like, that would also mean like, okay, again, what we started with is like your difference from a townhome to the semi
It's
to
gone.
a,
It evaporates right in front of you
in no time.
Yeah.
So what you were saying is important. It's like, it's based on your specific situation and if it fits your monthly budget and if you're able to afford it. Because the last thing we want is for, and me very specifically, I talk about this, is like the last thing I want is for clients to be house poor.
Yeah.
So,
or like, you have someone who's dreaming about home ownership and then they wait and wait and wait. Interest rates come down. They price themselves out of what they want because prices have gone up. And then they decide, I don't want to live in a condo, so I'm just going to keep renting my townhome.
but then that's the other thing too, is like
you missed the chance, right?
But even in the rental market, you're not secure.
Fair.
Because like we can, and we'll discuss this about in another episode maybe, but like landlords can essentially have ways they have to sell too at some point. So your low rent could not necessarily be the case. And what we're seeing right now in the market is the rental market is hot too. And
yeah, it's picked up for sure in the last couple of weeks, like from what I've seen some of my rental listings.
So it's whatever, again, going back to what fits your specific needs and your specific situation, I think is very key and important.
Agreed. Yeah.
So
anything else going on with you this week?
Not much. Thanksgiving coming around the corner.
Yeah, Thanksgiving. So. What are you thankful for?
You.
Oh, wow. Thanks.
No, thank you for good people, good friends, good family,
health, happiness.
Those are the important things. You start to realize that that's the most important thing in life. Right?
It's so true, man. It's especially after being sick for a few days.
Health, the most important.
God, what I wouldn't give to be healthy. No, that's good, man. You're gonna have some family kind of celebration on Sunday, Monday.
So. Yeah. How about yourself?
Yeah, it'll be low key for us.
Recover from the week of being sick.
Yeah, I feel like I'm up. I'm gonna get knocked down tonight. I have friends here from Newfoundland, so it'll be
Oh yeah, you have your friends who play in a band, eh?
Yeah, they're playing at the Redbird tonight. You should come if you're not doing anything. Fun.
What time is that?
It's like 7. Early show.
I might have dinner with family, but if not, I'll come
if you
back.
got time. Yeah, they're here for the one night only. So I'm sure it'll be a fun night tonight, and then we got some family photos. I've never done that before.
Interesting.
Really not looking forward to it.
I mean, do you need a haircut or?
I got a haircut. Fuck you.
Sorry,
I got one.
Sorry, Tony has a new look, so that's why I'm like making fun of it right now. It looks good though. It looks good.
I'm working on some things, guys. I'm working through some stuff. No, I'm going to like a pumpkin patch or the woods or something. It's not really my jam, man. I love my family to pieces, so I'll do it for them.
That's good.
And then we'll have a turkey. I don't know if it's gonna be turkey, but will it be some sort of poultry dinner? I'm guessing on Sunday night at our folks' place, so it'll be good.
I think we should also wrap it up. I feel like we may have lost a couple of people.
Wait, no one ever edges?
I don't know. It depends what they're here for at the end of the day.
Well, that's it. It is what it is. That being said, everybody, thank you for tagging along for this one. Maybe we'll actually publish it. I don't know.
Yeah,
we'll see.
I think we should. I think this feels good.
I think it's all right. So, again, follow us on the Ottawa platforms. Give us a like, guys. Comment. Let us know what you want to hear us talk about. What's on your mind. There's no bad questions.
Yeah, let us know. There's like you said, no question is.
Yeah. And if you ever want to have a private conversation with us, just check the Calendly links in the description below. Yeah. You can book a one-on-one session with either of us or both of us. I'm happy to sit down and chat you through what you're dealing with, what you're looking to do, and like I said, if it's 1 month, 2 months, or 2 years from now, we can have a conversation that kind of gets you set up on that path to make it a reality and not just some pipe dream. So, thanks everybody, appreciate you, Adolfo.
Thank you, everyone. Have a good weekend. Take care.
Ciao.
Peace.